While there is a lot of uncertainty and insecurity into what's going to happen to the future of finance, one thing is for sure, and that is that institutions can no longer ignore digital assets. They are here to stay. Please welcome to the stage our next panel, moderated by Anna Irrera, Senior Editor at Bloomberg.
All right, I'm looking for the timer. Yes? Okay, let's start. I'm sure the timer will start. I've been told we have to keep it tight. And we have an amazing, really, panel here. So I'm going to ask them to start off by introducing themselves very briefly so we can get down to the very big topic that we have in a short amount of time. Jean-Marc, do you want to start?
Sure. Good morning, everyone. Very happy to be here. Thank you for being on the panel. I'm Jean-Marc Stenger. I'm leading Société Générale Forge, which is the crypto asset arm of French bank Société Générale.
Good morning, everyone. Thanks for attending. Adam Levine, CEO of Fireblocks Trust Company, and Fireblocks is the leading digital asset infrastructure.
Good morning, everyone. I'm Rachel Conlan. I drive all marketing and growth for Binance. We're one of the largest crypto exchanges by users and trading volume.
Hello, everyone. I'm Elif Bilgi Zapparoli with Bank of America.
Hello, my name is Chuck Mounts. I'm the Chief DeFi Officer at S&P Global. S&P Global is a leading provider of data analytics and benchmarks in traditional markets, and we are looking to bring our skill sets on-chain.
Okay, so if you've been a frequent guest of crypto conferences or blockchain conferences or even traditional finance conferences, you've been hearing about tokenization for around, or blockchain for maybe 10 years, a decade. Maybe you've seen me ask the same questions. There seems to have been some change and a sort of revival and, you know, more activity. Does anybody want to set the scene and maybe tell us why the CEOs of some of the leading banks are talking about it now and seem to not just be paying lip service? Maybe Jean-Marc, you want to start, since I brought banks into question and then...
So maybe I would start by saying actually over the last 12 months or 18 months, actually I haven't seen a lot of changes. In the sense that to us and from what we are seeing, all this trend has already started like 18 months ago. We are just now in this phase where all these projects which were already decided and where we had people working and investment being made are just coming up now, being shown in the market. If I just take the example of what Société Générale is doing in the field, being now an issuer of a stablecoin, we have issued 2 stablecoins under MiCA, one in euro and one in dollar. These are obviously projects which takes time to emerge. The coins are live for a while, and we are now working with the DeFi ecosystem and the crypto space to create this adoption. This morning, for instance, we have just announced a major partnership with software wallet provider Consensus to make our USD stablecoin available to their 100 million plus users through the wallet MetaMask, which is a major announcement. You know, these are projects which takes time. It takes a few months to be live, and actually the wallets are live now. I mean, we are not just announcing that we will be working on that. It's live, and I think it's a concrete example of what is happening. It's just that we see all these projects and again discussions which probably have been already discussed last year at the conference, now coming into reality and making sure this convergence in between TradFi and crypto, which is anticipated for years, for too long, is now really happening in the market for clients and users.
Elif, do you want to tell us your perspective?
Yes, Anna, thank you. I think what we're seeing finally over the last couple of months is distributed ledger technology and programmable money is affecting multiple areas of traditional finance at the same time. And I can think of 3 main ones. One is wealth, the concept of capital allocation, and increasingly traditional finance firms are proposing some allocation into sovereign currencies. The second one is the whole payments discussion, which is whether it's stablecoin or CBDC, will corporate treasurers be using stablecoins as an alternative payment mechanism for global or even local concepts? And the third one is capital markets, will we see tokenized real-world assets or other versions of tokenization because of the powers of programmable money? So when you think of these three things, you're thinking of the entirety of traditional finance. I think that may be why people are paying attention.
I think from the lens of marketing, which is how I look at it, it represents such a compelling bridge between institutional and between the crypto industry, the OGs. I think for me, though, if you look at tokenization, it's really focused on fitting into where institutions already have the behaviors. So it's very easy and accessible. I think where there's still a long journey to go is where it's around new products and the tokenization of other assets that still require proof before the liquidity comes. So I think that's a space to your third point that's going to be interesting in terms of really driving to that adoption.
Chuck, we were having an interesting conversation before about how, you might have heard in the early tokenization days, that's tokenized real estate, art, wine, smaller, illiquid, esoteric, more esoteric niche markets, or even private markets. But now we're actually seeing money, treasuries, stocks, it can't get more liquid and more mainstream than that. What's happened? Did it not work for that? What's going on?
Yeah, I think, for me at least, when I got into the space 5 years ago, I was super excited about the revolution of markets that blockchain offers in terms of taking assets and democratizing access to those assets and then making them tradable in an efficient way. And so that was the initial point of excitement around private markets and illiquid assets or real estate and stuff. But what we've seen, of course, is that the first asset to be mass tokenized was the US dollar. And now that's been followed by other highly liquid, high quality assets like US Treasuries. And so when I take a step back, I realize that actually the revolution of markets that I think is still coming has to go through an evolution first. And we're in that evolution stage, which has gone from concept to actuality with tokenized money market funds and tokenized forms of cash, whether it's CBDC, whether it's tokenized deposits or tokenized currencies. But I think those all lay the foundation for the next leg of advancement and yield return and portfolio construction and risk management around tokenized real-world assets. And to me, that's the most exciting dynamic and foundation for developing the next stage of on-chain asset management and the ability to create very bespoke portfolios that have unique risk and return characteristics that you cannot get off-chain. And I think that revolution in market, which will incorporate a wide range of assets, whether it's esoteric illiquid assets, or new types of assets like intangible assets into portfolio construction in a way that's never been possible before. And so that's what I think we're getting teed up for right now for the beginning of the revolution, moving from the evolution stage.
So Adam, you guys sit behind a lot of these projects, right? So what are you seeing now concretely and what's changed? What are people and firms trying to tokenize you think that will come soon, right? We've hopefully established we're moving past a lot of only POCs that go nowhere. Where is the real action happening at scale that's commercially viable? That means they'll be able to pay your bills.
Yeah, you're exactly right. We're past the POC. We did a survey last year, and just under 90% of the financial institutions we reached out to either already committed or were committing projects to go live on blockchain, specifically focused around tokenization and or payments. And so what's interesting is think first on the retail side, you're quite right that some of the most liquid assets have been tokenized first, but it's giving access. When we talk about democratization, you can point to examples. One of our favorite clients I love to point to is Mercado Bitcoin, that has made it available for Brazilians in the retail level to invest in assets that those in developed countries normally have access to. And you're seeing neobanks globally that are doing this at scale, whether it's something like XStocks or other type of money market funds that they want to do. And that's really exciting. That's happening at scale. And I think it's a bit of a shot across the bow for institutional investors seeing that this does work. But there are some changes that need to happen. What we're seeing on the institutional side is proof that it works when you tokenize dollars, proof that it works when you tokenize other fiat money markets, and more access is excited. People are accessing these assets on chain, in part because of what you can do from a DeFi perspective and finding a way to get some yield on the asset that you otherwise can't do. but it's very clear in the major financial centers that they're seeing what's happening in emerging markets. They know there's going to be a disruption, and therefore they're actively working on projects that will be live at scale.
Jean-Marc, why did you, I mean, obviously you did tokenizations of bonds as well. Why are you so concentrated on stablecoins and money now?
Yeah, indeed, and I agree very much with what has been said, and that's really the journey we have been following at Société Générale. We started already in 2019 issuing our first tokenized bond on Ethereum, the public chain, not under a POC or a private network. It was really a live transaction on Ethereum, and we started by doing this because it's basically the core activity of a bank. It's probably easier to convince a compliance officer and risk managers to issue a bond than to trade Bitcoin at the time. But the basic for that was exactly that, to understand and to master really the technological aspect of this, because at the end of the day, it's an infrastructure topic for banks, and we certainly do believe that financial market and the financial infrastructure of tomorrow will be blockchain-based. So we had to learn with things we understand and we know every day, like, again, securities. So that was really the positioning we had at the time, and it allowed us to build this infrastructure, which is now production ready, which allow us, and back to Chuck's points indeed, to enter into what we believe is the perfect bridge in between TradFi and crypto, which is stablecoin. Also because the regulation is here. We have MiCA in Europe. Very soon we'll have Genius in Europe. So everything is there for mass adoption of stablecoin, and we also believe that there is a natural place for a bank like Société Générale to be a reference European issuer in that space. So we have ambition here, and we definitely want to position us in that space, answering clients' need, not only in the crypto environment, which are the early adopters of stablecoin, but more and more, and I can also only echo what has been said, also answer to requests we start to receive from corporate treasurers who are now willing more and more to explore what stablecoin could bring to facilitate their own cash management operations, cash pooling, cross-border payments. And that's how we see really the stablecoin business moving away and aside from its original place, which is again the crypto industry, into much broader adoption, not talking about interbank payments and what FMIs could bring on the table, which is again another step of adoption, I think.
So, go ahead.
I think also from a large financial institutions perspective, I think this is a conversation of the financial pipes. Right? Because at the end of the day, DLT is an alternative way of wiring the global financial system. So if you've got millions of clients, tens of millions of clients, and clearly there are some objective advantages to the concept of programmable money, right? I mean, you don't need a particular focus on that in terms of just the obvious advantages, then it may mean that it can alter the financial pipes of the global system. So then I think every one of us who's a player in that space obviously is paying attention. And I think that's how holistic and comprehensive it is.
Yeah, that's consistent with the conversations we often have with traditional financial providers, whether it's FMIs or banks or even asset managers. They understand that this technology is not short-term and it's really not a crypto story, right? And so they're building the tech for the future. They're seeing the use cases that institutions like SocGen have proven out, institutions like BlackRock and Franklin Templeton have proven out, and they're making that investment now, and that's why it's not about a proof of concept, and it's not the buy, sell, hold story of a few years ago at all. It's really not about crypto, but that investment is happening now, and we've seen examples, I've been saying for a while, that if you're not building now, you're going to fast forward to a very large acquisition. It's not a brilliant concept, but MasterCard has done that, and the DTCC have done that, and those sort of institutions aren't writing checks of 10 figures just by chance for a crypto story. They see that it's the future of plumbing, and they need to be working on it actively.
I like that focus on clients because from our perspective, like if you look at a hybrid operating environment where you have, up until Bitcoin, the entire global financial system was centralized for 1,000 years. Now we have an opportunity for decentralization, and we're kind of in this hybrid market where there are going to be component parts of decentralization with component parts of centralization. And so what we're striving to do, for instance, is look at providing the products and services to enable people to make solid decisions, understand the risks they're taking, no matter where they are in that spectrum, from centralization to fully decentralized, with a view that eventually everything will be on chain and everything will be operating on those rails. But in the meantime, we have to meet, our clients' needs where they are, and provide, take those baseline of analytic and benchmark capabilities to bring online as and when clients need them. So that's kind of how we're operating, trying to play the whole waterfront, leverage those skills, but make them applicable as our clients start to onboard here.
But I think that's what's so important, the financial infrastructure, the narratives that have changed so much from being the get rich quick, the wealth narrative, to one where we're seeing a full renovation of the financial infrastructure. And to your point, we spoke about this last night, you need to meet people where they are in their journey, and there's a lot of education that comes as part of that. But there's also a huge opportunity in terms of new product innovations that can support every stage of player where they are in their journey. So, I was with a group this morning, ShredPay, and they're a recently launched solution that's about helping kind of the small, medium-sized banks understand how to integrate into the value chain and use stablecoin. And those are, the real functional needs that businesses have in order to go on a deeper journey in this space, where we do see everything on chain, to your point.
Just wanted to add as well, I think in this discussion, we definitely see across our businesses blockchain technology coming into our TradFi space. But I think it's also fair to recognize that crypto in itself, cryptocurrencies, are also coming on the other side in our own space, and it's also an asset class which definitely is more mature today, with an industry which is more solid, with regulation again which allow us as banks and financial institutions also to deal more and more with this ecosystem and these assets. And just again to illustrate that, we are definitely using DeFi as a tool to promote and develop the usability of our own stablecoin. We notably have integrated the Morpho protocol for that. But for that, now we have clients who are also able to lend or to borrow our stablecoin against Bitcoin as collateral, and that's perfectly fine. I think it's also important in this type of conferences and audience to recognize that crypto is becoming also mainstream and not shy away as, again, financial institutions from this environment, and to say, and again, it's also the case for Société Générale, to say that more and more we see the crypto industry as partners, just as we do for traditional industries, whatever the sector of activity.
How much I was talking about this, but how much is crypto now a potential client, right, for that to buy some of these products, right? It's interesting that you're focusing on Web3 users for your stablecoin. Are they like the initial buyers, even a tokenized money market fund or tokenized treasury? Like, there are big crypto firms that have not had access as easily as other investment firms, and they now are big pools of capital. So how is the financial sector approaching crypto as an industry to target as clients? When did that switch? Because we went from not being able to open a bank account to now having people offering bank accounts and like, let me manage your money very quickly.
I think very clearly for us the switch happened like 12, 18 months ago. And again, it's a trend. It's the early period of time of this. The crypto industry is maturing as well. But definitely, and again, now with MiCA in Europe, we have completely witnessed this change in posture and in tone, which make that we now have in front of us crypto players who have the level of maturity, the internal organization, the procedures in place, which allows to build, concrete commercial partnerships and discussions in between a bank and them. And I mean, we have a lot of partners here in the crypto space. And again, I think the stablecoin is the best way to establish these partnerships, then to elaborate and to build more and bring more services and products together in the market.
Maybe I can add to that. I think, Anna, it's an entirely regulatory conversation, right? Because for the traditional finance, for a long time, there was not only regulatory lack of clarity, but regulatory repercussions, right? Given the risks involved. So there was no space for much movement. And again, 12 to 18 months ago, that has changed primarily in the US. And I think that has created a lot of impetus for everyone else to feel comfortable that we can take a look at this technology and how we can use it to offer better products and services to our clients.
We're obviously a retail platform. You know, we have 350 million users across 180 markets. 18 months ago, we added 150 million users from that point of the spot approvals, you know, the clarity in the US. You know, that institutional capital influx fueled what was the retail narrative as well, and the entry. And so the symbiotic nature of institutional retail working together to drive more legitimacy and to really bring more users in and truly make this mainstream and part of everyday infrastructure. You know, it's an intertwined narrative that's critical.
It's interesting when you think back. It was probably just even a couple of few years ago where the mantra, certainly within traditional companies, was blockchain, not crypto. Crypto was still toxic. But you could talk about blockchain.
I remember well, I would get chastised if we associated one with a bank close to crypto.
Crypto,
digital
you get
assets
sent in
at
the
best.
corner of the room. And what you're talking about really is a mainstreaming of both, which is crypto as an asset allocation, and certainly, at least in the US, getting your first spot Bitcoin ETF and Ethereum ETFs were big steps in democratization and kind of standardization into the marketplace. And just kind of at a personal level, like when I have a Wall Street background, spent most of my career on bond trading floors. And so when I tell my cohort of ex-colleagues that it's irresponsible not to have a crypto allocation to your portfolio, they look at me like I'm nuts. And my wife even said, don't tell our friends that, they think you're crazy. That was like 18 months ago. Today, it's actually, that's not an outrageous comment. Like, it's already been socialized even at a personal level, and I think that pathway is accelerating, and we were talking about this at dinner last night. This pathway of perhaps blurring the traditional lines between retail markets and institutional markets. And I think that crypto and the evolution of on-chain capabilities and portfolio construction may be the kind of the pathway where that happens.
Crazy doesn't mean you're wrong, right? Like your friends might think you're crazy, but the narrative previously was the retail-facing banks were watching dollars leave and go in the US to Coinbase, go abroad to Binance, and then they had the benefit of FTX and everyone said, okay, you're crazy again, right? But now they understand that it is mainstream. When you can take retirement funds or your institutional investors have an easy way to get access to crypto, it helps a lot. And then use that same technology for getting yield on a version of a dollar, a version of a money market, or Bitcoin. That really is opening people's eyes. And you hear less and less it's used for terrorist financing, right? After what happened October 7th, the amount of money that was captured because of the on-chain analytic companies is so much faster. And you have that same conversation with the compliance and risk officer. Like, all right, you really, really don't like terrorist financing? Cool. Give me all your $20 bills and your $100 bills, because those are the two assets most often used for terrorist financing and money laundering. And then you start to realize that those antiquated ideas are no longer the main conversation. But I would argue it's gotten less bad, not quite good in terms of crypto.
I wanted to, because you brought up FTX, right? If same as you've been hearing about blockchain, if you've been in crypto, crypto is kind of its worst enemy many times. So it's not like things happen out of the blue and they just happen to it. So I guess what are the risks? What could set back? Because normally what happens if there's a big crypto crash, it sets back conversations that a regulated entity is having with a regulator, and also morale of retail investors hasn't really gone back to the heyday of like NFTs and it's way more muted, right? Like, is there a certain level of retail investors that's kind of had enough? And we're at the same time also seeing crypto investors move on hyperliquid to trade tokenized oil and want access to treasuries, right? So, what could hamper this rah-rah moment?
I would say at Fireblocks, what we've noticed is when there's a bull market in crypto, there's an increased usage in stablecoins, but it doesn't pair back the same way when there's a bear market. And the irony of what we've seen over the last few months is a bear market in crypto prices, but increased utility of digital assets. So there will always be some own goals in the industry. I think traditional financial institutions are very good at own goals that has nothing to do with blockchain. So some setbacks on crypto don't inherently mean...
We'll have a combo of crypto and financial institution.
Hopefully not, right? But it's a little bit of sometimes people in glass houses throwing stones. But what I would say is while there will be some challenges, what's clear is there's enough people that see the benefit of why you want to tokenize an asset, and therefore any issues around AML or fines or bad behavior is not enough to kill an industry.
I think we need to keep in mind that crypto or sovereign currencies is just one application of blockchain and DLT. And the real concept here is programmable money. Right? So we need to, in my opinion, continue to invest in the wider space as we discuss, whether it's stable coins or tokenized collateral or tokenized RWA, and crypto becomes a real wealth allocation discussion from a sovereign currencies perspective. One other thing, Anna, is the whole governance aspect of it, right? I mean, of course, we're talking about Genius, which has been very helpful, potential clarity, but there is still a lot of global discontinuity from a governance and regulation perspective. And DLT is borderless. Regulation is very, very much on borders. So that also potentially creates a bit of a challenge, especially when we think of scale, large users, like what these institutions here are representing, I think.
I think on this, the big picture that we are talking here about the digitalization of finance and the platformization of an industry like the banking and financial industry, which was largely centralized, operating on what I would call the old-fashioned business model, into something new, with new business models. And the technology which is allowing that is blockchain technology. It's an enabler of this massive trend we see in other areas. And finance, again, it's not immune from this. So the end picture is probably, yes, that we will see new distribution models. We will see assets, different type of assets being offered under a tokenized format, because again, it's easier to distribute, it's easier to originate, it's cheaper, it's quicker, it's safer. Often it's misunderstood, but I do believe it's also safer. And it's someone working in a bank which tells it. So, and that's what we are seeing, and there are different paths of adoption. Cryptocurrencies are the native assets where all this has started, but again, we'll see it, I think, very rapidly for cash, which is indeed the next asset which is being tokenized at scale, with use cases which are, again, far beyond crypto, for payments, but also for collateral management and interbank payments, which in terms of size has nothing to see with the volumes we are seeing now in the crypto space. And that's where we are also focusing a lot of our efforts at Société Générale Forge, because it's the end game. And we start to see brokers, online banks starting to offer tokenized equities. We're already talking about tokenized ETFs, money market funds under a token format to offer a yield solution. And I think that the trend we are all witnessing at the moment in the market.
But I think what's really interesting is, going back to what you're saying, the functional use cases are what's going to drive the next influx of retail users. But then there's this huge opportunity to introduce them to assets that traditionally many people, these type of investors would never have understood or had access to. So it opens up a broad, range of new potential product ideas. We were discussing Pakistan and India, Philippines last night. They're not traditionally people like the West that had stock portfolios. I mentioned when I moved when I was 24 to New York, everyone was like, what's in your stock portfolio? I'm like, what's a stock portfolio? At 24, coming from Ireland, it just wasn't something that was part of our vernacular at home. But what will open up is bringing them on once they enter into the functional use cases, is how you introduce those new types of asset classes to them and get them to go deeper into their journey.
I would actually kind of tack on to this conversation you asked about a few minutes ago about kind of the next crisis or what could derail it. And Like looking back, like I'm sure people in this room remember something called the global financial crisis. The historic traditional financial system has countless, dozens, hundreds of examples of systemic failure. And then rebooting and reconfiguring. There's absolutely no reason to think that that will not be a pattern that you see in this market that's developing. There will be setbacks, there will be scams, there will be kind of untoward things happen, but that will not stop the advancement, because the advancement of the democratization of access, the lowering of the cost, lowering the cost of capital, those are fundamental truths of what blockchain can deliver. So we should expect to see that undulation of like high times and low times, but the progression will continue very solidly. So one of the aspects that's going to come more into bear as this comes into the mainstream is the elevation of new types of risk, including systemic risk. So for instance, what happens if or when stablecoins become the largest buyers of US Treasuries? What are the systemic implications of that? What happens with on-chain forms of cash and deposit flight out of financial institutions? What are the implications of that around financial stability, around economic growth? These are all topics that are still coming. And what's important is that the industry is well prepared to have those conversations and engage proactively with policymakers and product people within organizations to have as smooth of an advancement as possible. And we're at that stage now. These conversations are happening now, from my perspective, where they weren't happening like 3 years ago.
To add on that, I think on the concept of tokenized cash, which is let's say stablecoins, it's interesting to see the different approach US versus Europe is taking, right? In the sense that US is very much obviously stablecoin and a CBDC is prohibited for now, whereas Europe seems to be, for reasons that are not just technological, for reasons that have a lot to do with sovereignty, are now onto the two ECB trials. I think it's going to be interesting to see both the wholesale and the retail CBDC, Euro CBDC, because when you really think about that interplay between stablecoins and CBDCs, I think, let's see which one is, maybe I think most likely all will coexist.
And it's quite interesting because we're taking this very meta now, but it is, a technology that makes money borderless, but the world is becoming very border-centric and sovereign, and, geopolitically it's not all, roses out there right now. So, it's interesting to see that it's also being seen as very much a geopolitical tool, and how do you approach it? Europe is taking a sort of dual track, and, but it's fascinating that everything is now being discussed by, even executives at firms that wouldn't have discussed it before.
But it took 100 years to build the financial system, the plumbing, the governance as we know it. In less than 5 years, we've seen regulation advance. As we discussed last night, what's going to be key is whether in this acceleration area, whether regulation can keep up with as fast as the technology in the industry, is evolving. So.
The last minute, Chuck, are there any other sort of underappreciated risks that are imminent that you think might, you mentioned sort of what happens when something happens to stablecoins, and they're the biggest holders. Some of them are already top 20 holders of US debt, right? So
yeah, so I think there are quite a few systemic considerations. When you look at the collapse of FTX, there wasn't really a policy consequence of to that, like you would expect to see. Like you didn't get a Dodd-Frank in response to that. But when blockchain capabilities become integrated into the fabric of the marketplace, and crypto also becomes more integrated, you'll see, I think, a more coordinated policy response around whatever that next downturn or that next catalyst is.
I would just add, I think there's a lot of innovation happening in prediction markets, and for many, especially in retail, prediction is just a version of gambling that may or may not be legal. But on the institutional side, prediction markets with a 24/7 component offer an interesting opportunity to hedge. And I think what happens in that space, both with regulation and retail and institutional, looking at the markets for different reasons, that'll be interesting to see how it continues to innovate.
Could I just add one thing? So I think when you look at prediction markets and you think about the evolution of markets from here, one of the most exciting aspects is around on-chain asset management. And so we spend a lot of time thinking about vaults and how that evolution in the marketplace is going to lead to kind of a greater shift in the overall marketplace of on-chain investing. And there can be lots of new risks. So some risks are mitigated, like counterparty risk, but there are new types of risks that are introduced. And so we spend a lot of time thinking about what are those risks and how do we measure them, and then how do we help investors navigate pricing those risks and managing those risks.
New risk, but also a lot of new opportunities.
Okay, on this positive note, we have 15 seconds, so that you don't say journalists are always negative. So leave you on this positive note. Thank you so much, everyone, for the wonderful discussion.
Thank you.
Welcome to Signal Week.